Welcome to the How to Buy or Sell a Business Successfully podcast. The concepts discussed in this podcast are for informational purposes only. No attorney-client relationship is intended or formed by this podcast. No legal advice is intended in the substance of this podcast. Feel free to check out our website, www.goforemanlaw.com. Enjoy the show and welcome your hosts, Jake Wayman and Sam Foreman. Welcome back to How to Buy and Sell a Business Successfully. We are in the second of a four-part series on SBA loans. Today we're focusing on using SBA loans to buy the assets of a business. Our focus in this series is on using the SBA loan programs in that context, although they can be used for other purposes. The SBA guidance is hundreds of pages long and changes from time to time. So please consult with your banker or other professional advisors for more detail and to stay up with relevant changes. We'll cover a lot of practical advice and key concepts in today's podcast, and hope to provide you with a really good starting point on your journey. But please remember that there's a lot more detail to be had than what we're going to cover here. This podcast is not legal advice, and no attorney-client relationship is formed by this content. Also, and hopefully this is not a shock to anyone, it's not a credit approval. You have to fill out a credit application for that. So make sure that you start the process early with your banker and that you talk to them in detail about what you need and when. And please remember that as we talk about, especially some of the things that have changed with what the SBA rules will allow, that just because the SBA will allow it does not mean that your bank will. And so make sure that you've got good communication with your banker early about what you need and what they will permit in the process. So with that, let's introduce our esteemed panel today. Jill.
Hi, I'm Jill Garcia with Emprise Bank, and I'm our SBA Administrator.
Hi, my name is Ben Renn, also with Emprise Bank. I'm a business banker that focuses on SBA lending and healthcare lending.
I'm Sam Foreman. I'm a business attorney, and I work with a lot of folks who are buying and selling businesses.
And I'm Jake Wayman, and my wife and I are small business owners of the Orange Theory Fitness Studios here in Wichita. So within this episode, we're talking about buying the assets of a business. So in that situation, you're going to have a seller that's involved who's selling their business. So say we're working through that, and the seller, and you want to have the seller involved in, the financing of it. So how much can the seller finance in the process of buying the assets of a business?
Yeah, really, the seller can finance as much as they're comfortable with. The main thing for us is knowing how much they want to finance, rate and term, and what that payment is going to look like. So that way, when we're looking at a whole deal, trying to get to an approval, we know how much is coming from the seller, how much we're financing, getting to an overall payment, and making sure they can afford that.
And does the bank generally require that a seller that's providing financing subordinate, put their
Yes.
security rights in a second position to the banks?
Yes, that is correct. Yep.
Okay.
That document comes along with it.
Yeah. So they really need to have that conversation early as they're putting together the deal terms, so that if the seller's not aware that, hey, I'm not going to have, first position on those liens, then they've got clarity around what that looks like.
Right. Absolutely. It would be a good conversation to have with the seller so they understand going into it.
Right. Does that usually come along with the requirement that they defer payments, or is that going to depend on kind of cash flows, from the business and those kind of things, like a standby type of agreement?
Yeah, the deferral of payments really depends on how that seller financing is being used, whether it's just an alternate financing source or whether it's part of the actual equity injection. Because if it's equity injection, then we do need to look at deferral of payments. There's some lots of things that can go on there that we can talk through later. But mostly it just kind of depends on what those funds are being used for, like just for an alternate financing source or whether for the equity injection.
No, that's great. And as someone who has represented many sellers, I do know that they like to get paid. And so as you're doing your deal and you're working out those payment terms, with the seller, make sure that that conversation happens really early and that you've got 100% clarity, or at least as best you can, with your banker on what they're going to require, so that you can communicate to the seller if they're not going to be paid right out of the gate, here's when they're going to get paid and what that looks like, because they will care.
Yep.
They will care when they get their money. So,
Yes.
And we'll talk in more detail about how that interplays with equity injections under certain circumstances in the next episode.
So when you're looking at it, I know we touched on this in the previous episode, but how long can a business owner or soon-to-be business owner, what do they take consideration for how long that loan process is going to take?
Well, I think it really depends on the people that you're working with. If you have people like yourself working a deal that are very quick to get everything back to us, we like to get through to a credit approval. And then once we have an actual approval and we're working through the process, 30 to 45 days is not an unusual turnaround time, I think, for a closing, as long as we're getting information in from all the parties that we need within in a timely manner, and can keep moving forward. Yeah.
So 30 to 45 days from when they have an approval.
Correct.
And so when somebody first meets with you to when they have that approval, roughly what's kind of the range that you see on those timelines?
I mean, generally, I think we can turn that around pretty quickly. Again, I think you'll probably hear it depends a lot in a lot of the stuff that we talk about right now. But, generally once we get the list of information we need for sort of that initial credit request or loan request, as far as, financials, if you're buying the business, we need all the seller financials. We'll need some personal financial information, all that type of stuff. But generally, once we get that, we can get an approval within a week or two and generally turn that around pretty quickly. I think with most situations, I'll get all the information, submit the loan request. Underwriting, who's not here to defend themselves today, but underwriting is always going to have questions, but that's their job. And so normally there'll be at least one more follow-up with the customer of saying, hey, we sat with the underwriter, we visited about this. They would like to address these specific items. We get that information, kind of get it back to the underwriter, and generally can turn that approval around within a week or so. Then that's kind of where Jill's team comes in as far as, okay, here's the next steps in the process. Here's the items that we need for the SBA specific stuff, and then get things moving from there. Get the attorneys involved, all the other stuff.
Gotcha. So like 30 to 6, so like really like 60 to 90 days in terms of total loan process from when they have that initial meeting with you to when they're closing on their deal. Is that a good
I would
rough estimate?
Generally, yeah.
And then for some folks, if they're really well organized, they have their stuff together, Jacob. They're really responsive. They're really on time. So the borrower's not an attorney. They're gonna have, they might be able to do it in 60 days, perhaps,
Correct.
Or perhaps even a little bit less if they've really got it together. And then on the other end of the spectrum, if you've got folks that are, not organized, they, it's not the top of their priority list. They take a while to get it back. When it comes back, it's not complete. It has to go back through underwriting. Underwriting has additional questions because it's not lining up with something else, or it just creates additional questions for whatever reason. Then that might take even longer. And so people need to plan, prepare, be organized, talk early about what's needed, and make it a priority to get it back so that process goes smoothly, accurately, and in a time efficient manner.
So as the business owner, don't be the bottleneck. That's all I'll say.
I mean, I will say, I think
as the attorney, also don't be the bottleneck.
I think don't complete is one of the keywords that Sam said there. And I think it's surprising how often, we may send out a list of 10 items of, hey, these are the 10 things that we need to move forward with this. And we'll get an email back with one item. Well, there's still 9 items out there. And then they may sit for a little while and say, hey, are we ready to go? I'm like, well, no, we still need the 9 other things on that list. So that's where the more communication and the quicker the response time on that, the quicker we can move forward with our end of things.
And speaking from a business owner perspective who's been through this process, is those things are requirements by the SBA. It's not because the bank doesn't like you and they want you to do all these things. It's because it's required to go through the process. And trust me, once you get through it, you'll understand why. So when you're asked for certain things, know there's a reason behind it.
I think it's a great point.
Yep. So what does the borrower have to bring to the table to just kind of get the loan, especially from an SBA context?
So as far as the stuff that they're looking at bringing in, I think kind of to follow up on what Jacob just said there, a lot of the information that we're asking for this with the SBA, it's stuff that the bank's going to require for a loan request anyways. Sometimes there's just a little bit more information we may need, but also one of the benefits of using the SBA program is that can also kind of reduce sometimes the amount of down payment that the borrower has to bring into the project or the purchase. That's honestly like a big piece of what we've seen a lot of lately of someone that's looking to buy a business. Generally on the traditional lending side, we're looking at 20% down on a lot of projects. With SBA 7A, sometimes we can get it down to 10% of the injection that they have to do. There's a little bit more specific information we can get into later, but
where was that deal for me?
On some deals, yeah.
It depends, Jacob.
You're unique and special in a lot of ways, Jacob.
Just not the right ways.
Right. Well, and
many wonderful
also,
ways.
And also, there's been some changes in the programs over the last couple of years as far as the requirements. I think that the SBA has seen some things post-COVID that they have definitely loosened up on some stuff, and I think they've made some changes where they're really actively trying to encourage more small business lending. And so they've loosened up on some requirements. They've lightened up on some fees as far as that structure. So, it's a really good time right now to try and utilize SBA lending.
Yeah, absolutely.
No, that's terrific. So from a down payment injection, cash injection perspective, are there kind of fixed lines that either the SBA requires or that most banks require on it? Or is it going to be kind of a case-by-case basis under the new rules?
Well, I think SBA in general, minimum down payment is 10%. Our bank does follow that rule generally, unless there's something when we get into the deal that we feel more comfortable with more of a down payment. But again, every bank can have their own requirements about what they're going to require for a down payment. Yeah.
Right. And so this is a good example, this kind of topic about what does the borrower need to bring to the table, where there's maybe some more flexibility under the current SBA rules about what the SBA will require, but where people really need to have that good conversation up front with their bank and good communication throughout the process. Because just because the SBA permits it doesn't mean that your bank will. And ultimately, the SBA is not going to loan you the money directly. It's going to be your bank that does it, and the SBA signs off on. So from a collateral perspective, what should folks expect to need to bring to the table? Is there like a loan to value ratio that they need to be tracking with on the purchase of a business? Or is it, is it a little bit more, hey, here's our general rule, or here's an SBA general rule, but there's flexibility from the bank's perspective as they look at the totality of the loan application and what they feel like the overall risk is.
So I'll try and start here, and then you tell me where I go wrong on this. So again, going back to it depends. So every business acquisition or buy-in is different, and some of them may be a company that is significantly heavy on equipment and there's a ton of collateral available. And sometimes, it's all blue sky and there's very limited collateral, very limited inventory. So there's going to be a significant collateral shortfall. That is where like the SBA comes in and is really, really beneficial in this because, doing a piece of real estate's easy. Like you get an appraisal on the real estate, you know what the value is, and you say, okay, we're at this loan to value. That's all we need to do. On a business that has, it's a $500,000 business purchase that has $50,000 of equipment, that's a lot of collateral shortfall. So that's where the SBA comes in and helps out on that. Again, depending on, it's specific to different deals and different programs, but at certain loan amounts, there is additional collateral requirements as far as from the personal side. So if you have equity in your home, sometimes that may be a thing where we have to take the available equity as a second mortgage on your house. Sometimes if there's other property, other equipment, again, it depends on case by case, but I don't know what other thoughts you have. If I missed anything?
No, not really. Yeah, that's most of it. Yeah, so, we're going to look at your personal financial statement to look and see what's available.
Because at the end of the day, the bank's looking at risk, and it's going to look at, okay, you might have like a business appraisal, which every SBA loan is going to require when somebody's buying the assets of a business. And the appraisal for the business might be $500,000, which includes the blue sky, the goodwill, but the hard assets, like you said, might be $50,000. And from a bank's perspective, the bank, from a credit risk standpoint, might require something more than just that's great. That's what yesterday supported on goodwill, but how much is goodwill actually going to be worth if the business fails and the bank is in a position where it has to foreclose on assets, which is what the underwriter's job are to think through.
Right.
And they're not here to defend themselves.
Right.
No, that's great. Life insurance. This is a great opportunity for us to support our friends in the life insurance industry. Whether or not your SBA loan requires you to carry life insurance, you should, because it's smart and you should do smart things. So that plug aside, what is there a specific requirement, like an always has to have this much life insurance or this percentage of life insurance, Jill, or is it
generally generally we require, if a life insurance policy is required on the loan request, it usually has to cover the loan amount.
Okay. And is that something, how often does that happen? Is it
lot.
usually? So if somebody's coming in, they should just assume that, hey, that's going to be something I'm going to need to bring to the table.
I would assume so. Yeah. If you know you're coming in and you're buying a business,
Right.
I would assume that you're going to have some form of life insurance.
Right.
Yes.
And so is this something where somebody can, hey, I've got a buy-sell agreement with my business partners and I've already got life insurance there and now I can just pledge that over here? Or I've got a personal policy, or is it something where the bank's really going to want to see, no, this is a policy that doesn't have any other purpose than to protect the bank?
We do want to have what's called like the first lien assignment on that policy. So, could it be used for other things? Maybe, if there was still. But we're going to want our first position on that policy.
Yeah. And in my experience, I actually had to get a separate policy out for our SBA loan that was specifically for that was covering the amount of the loan.
And I think this goes back to, again, like shout out to life insurance friends, but also to accountants, to attorneys, to all of that. And this is, I think, maybe just a point that I'll insert, again, stressing the importance of having a team of all of these, because all of these different things are factors that go into the decisions you're making and doing that, because you want to talk with your accountant about there could be certain business advantages for running the payments through the business on doing that type of thing and expenses that you can do through that. You want to talk with your financial planner about, you want to make sure your family's set up and covered with stuff there, but also, if you have to have additional coverage for the bank. There's a lot of pieces that go into it. Sam and I and Jill were at a conference the other day, and one of the segments they had in a breakout session was about life insurance. And it was some really beneficial information that I hadn't thought about or heard kind of applied to the business side of things. So definitely encourage you to look into that as well.
Yeah. No, that's great. And as you plan, preparing to come to the application process with life insurance, either ready to have that application process, but especially if you've got multiple policies already in place, knowing that process might take a little bit longer, because generally in your application process, the life insurance company is going to want to know basically how much outstanding do you already have, so that they will be able to kind of weigh that in their risk process. And so if you've got a lot of policies out there, that process might take a little bit longer. Personal guarantees. I know this one comes up a lot, but my understanding is that a personal guarantee from somebody is always going to be required.
Yes, there's at least one.
One individual has to fully guarantee the deal.
Great. And so if you've got, a multi-owner borrower and, one of the people owns, like, let's say 5%, does it just by themselves? Do they typically need to, expect to be a guarantor, or will they often be exempted from something like that? Or is it going to depend?
Again, it depends. The easy answer from the bank side of things. So anyone that has 20% or greater ownership in the company, like, we're going to require them to personally guarantee the deal as well. There are case by case basis where sometimes we'll look at a limited guarantor. But again, that also, if you've got multiple partners, that also is an internal decision for those people as well. Because if you've got if the four of us are there and Sam's 25%, and I'm good at math, so that doesn't quite work out. But if we're all below that 20%, but Sam's the only one that's having to personally guarantee it, that may create some issues internally as well. So sometimes you may want everyone else to do it.
Can I get around some of those guidelines by splitting it up with my spouse? So, like, I own 9.9% and my spouse owns 11.1% or 10.1%.
Right. The SBA combines.
Okay.
the percentage of ownership in a spousal relationship. Okay. Yes. No, so we would add yours together. Collectively, you guys then are more than 20, so you'd both have to guarantee it.
Gotcha.
Well, something they can look at too is they look at your assets, what you have personally, and if it doesn't have enough there, I mean, they'll probably ask some of your investors what are their assets out there, and if they have some that are, they'll have to come up with either a partial guarantee or something like that. But it's like what Ben said, is having that transparent conversation with your partners if you have them, that's a possibility of them having what they have to bring to the table as personal guarantees.
I think kind of the overriding principle for folks to remember here on a lot of this stuff is that the new SBA guidelines give banks some more discretion on what they have to require on some of this stuff, but your bank is in the business of making good loans, and they don't want to take on a risk that they're uncomfortable with, and so they're going to look at each of these items, whether it's how much down payment do you have to bring to the table? Is it 10%? Is it 20%? Et cetera. What kind of collateral do you need to bring, especially if there's a lot of blue sky involved? What kind of life insurance requirements? What kind of personal guarantees, et cetera? They're going to look at all of this through the lens of, how do they feel about the loan? What kind of risk is going on here? And how do they get comfortable and have confidence that they've got something here that's going to work for the borrower and the lender, to get paid back? So Jacob, I think you've got the next question for us here.
Yeah. So with this episode, we're talking about buying the assets of a business. And so there's going to be a seller that's involved in this. You're buying the business from another person. So how much can that seller finance if you want to have them involved in the process?
I think that's another question. The seller can carry as much as they want. If they want to carry 100% of the deal, they can do that. That's what the seller is willing to do. From our side of things,
we're pretty open too, right, really, to
if we're doing lending and doing SBA amount. The borrower has to have a minimum of 5% down.
Well, yeah, you're talking about equity injection. Yes, of their 10%, they have to at least be able to put the 5% down. But as far as the seller actually financing it, they can finance as much as they want. We'll have to know the terms and the repayment structure of that so that we can factor that in, because we want to make sure that our loan gets paid first. Really.
Yeah, and it's not an all or nothing. So it's not like there's different ways to piece this out and everything to make it work. So if you do have a situation where the seller's like, no, I want to sell my business to this individual, there's ways to make it work, basically. You're bringing it all to the table.
Yep.
Okay.
A key topic that sometimes comes up is how long and what kind of services can the seller or the owner of the seller provide. And for a lot of folks, from a lending perspective, it's kind of that 12 months, can't be in a control position. So can't be, making key decisions. There's really got to be a transfer of the business. As I've looked at the new SBA rules, I'm not 100% clear on what it allows. And so I may have some follow-up content on that. But the key thing to remember is if that's an important part of transferring the value in your deal, you need to talk to your banker early on about what they are going to permit, because, again, they don't have to allow what the SBA will allow. All right. So let's kind of talk about some key takeaways for folks. If there's just kind of one nugget that you'd like folks to come away with from today's episode, Jacob, what would it be?
Yeah, from a business owner's perspective, it's really come prepared. There's a lot of pieces to the puzzle, like I've mentioned before, but as a business owner, you need to be the one who's coming prepared to these conversations, but also be transparent. Don't come in trying to hide something, because, it's all going to be out there, because at the end of the day, you're trying to get a loan, and the bank needs to know exactly where you're coming from.
That's great. I think really remembering that things have changed in terms of what the SBA will permit from an underwriting perspective, but that doesn't mean that your bank's view of risk and how they underwrite the loans is required to change. And so start those conversations early and have really good communication. How about you, Ben?
I would just say don't be afraid to reach out to a banker. I think a lot of times people think of us as mean, scary people. We're not that bad. But honestly, like, every deal is different, and we've seen a lot of different things over the last several years. And so, don't hesitate to reach out and say, hey, someone presented me with this opportunity. Here's kind of my questions. Do you think this is a possibility? Because there's a lot of different ways that we could look at structuring the deal that may figure out how to find something to be successful to move forward with the purchase. And
so folks shouldn't be their own underwriters. They should let you.
Yeah,
do that.
don't determine whether or not how much you are or are not getting before you've kind of had some conversations and looked at that.
And how about you, Jill?
I would say be prepared to be asked questions, because we're going to have a lot of questions about your own personal assets and your personal financial statement. We're going to be diving into all that information. We're going to want to know a lot about you, and if you have the qualifications and the ability to manage this new business, because we got to be we got to know that the business you're buying is a good business, but also that you'll have the ability to run that and be successful with it, because we also don't want to set you up for failure either. So, yeah.
No, that's great. That's great. One of the things we like to do on this podcast is share a wellness tip for folks so that they can have a great deal experience. Ben, what kind of wellness tips do you have for folks today?
So my tip for today is one I've heard you mention before, but I think it's kind of a good point. And allowing yourself to have some margin in the process. Buying a business, I mean, Jacob has talked about it some. I mean, it is a very complicated, can be a complicated and long process. And so just allowing yourself a little bit of grace and timing there's other stuff you've got going outside of this deal as far as being with family. I mean, you may have other work that you're dealing with as well. And so just building in a little bit of extra time to allow for kind of moving forward through the process, but not having it be all consuming.
No, that's a great tip. That's a great tip. Well, thank you everyone for joining us for this episode as we discussed using SBA loans in an asset purchase. Join us on our next episode as we discuss using SBA loans for partner buyouts and other purchases of ownership in a business. Thank you for joining us today. For future episodes, please subscribe to the podcast on Apple Podcasts or Spotify. And please check out our website at www.goforemanlaw.com/learning.